For many dentists, owning a practice represents a major career milestone, one that offers autonomy, personal fulfillment, and financial potential. But while clinical training prepares dentists to deliver exceptional care, it rarely addresses the financial realities of running a business, and that gap in knowledge can have serious consequences. Owners often assume that if they stay focused on patient care, the rest will sort itself out. Unfortunately, that's rarely the case. In fact, one of the most common reasons dental practices struggle or fall short of their full potential is poor financial planning, especially around taxes and compensation. One of the most important decisions you'll make early on is how to structure your business. This choice has long-term implications for how your income is taxed, how you get paid, and how the practice grows. A sole proprietorship may seem like the simplest option, and for a very early-stage startup with little income, it might work temporarily, but it offers minimal protection and limited tax efficiency. An LLC or partnership is a better fit for collaborative ownership models or those seeking added flexibility. This structure requires registration with your state and an EIN for federal filing purposes. For most independent practice owners, the S Corporation, Form 1120-S, is the most tax-advantaged structure. It allows you to divide your income into two components: wages, subject to payroll taxes, and distributions, which are not subject to self-employment tax. This split, when executed correctly, can result in substantial tax savings over time. Especially if you're operating as an S corporation, it's critical to distinguish between your role as a clinician and your role as a business owner. The IRS expects that dentists employed by their own S corp receive a reasonable salary. You can check the average reported salary in your area by visiting salary.com and searching the occupation dentist and your zip code. After the salary is paid, any additional net profit from the business may be taken as owner distributions, but only if the practice is financially healthy. If the practice is not generating sufficient profit, distributions should not be taken. Doing so prematurely can lead to IRS scrutiny or unanticipated tax liabilities. Distributions can be a strategic tool, but they require discipline. Unlike wages, taxes are not automatically withheld from distributions. To avoid tax time surprises, it's recommended that you set aside 40% of every distribution into a dedicated tax savings account. For example, if you distribute $10,000 from the business, immediately allocate $4,000 to the tax reserves. This approach ensures that when estimated or year-end taxes are due, you have the funds available and may even benefit from over-saving once deductions are applied. Payroll may seem like a back-office detail, but it's essential to your compliance and financial health. A reputable payroll provider will ensure that taxes are accurately withheld, filings are completed on time, and records are well maintained for your accountant. Choosing a trusted company helps reduce risk and gives your financial advisors access to the important information they need to support you effectively. Avoiding payroll errors not only protects your business, but also strengthens your credibility with lenders, investors, and regulators. Remember, payroll tax liability follows you for life, even after you sell your business. Make informed decisions early. Seek the support of qualified advisors, and treat the financial health of your practice with the same care and attention you give your patients. With a strong foundation in place, you'll be better equipped to lead a thriving, profitable practice for years to come. This video is for informational purposes only and does not constitute tax, legal, or financial advice. Please consult with a licensed tax professional, attorney, or financial advisor to discuss your specific circumstances.